Hello everyone, welcome back to our CFO series wherein we deep dive into CFO, business, finances for startups and growing businesses. And today we are going to talk about very interesting topic which is equally important for an early stage startup to a growing company or a manufacturing company or a very large enterprise. How to prepare a budget for a company. Budget is really important in terms of an indication for a business to understand where do we want to grow it up, as well as how do they plan for their resources, for their expansions, for their cash flow management. So it is really important to plan your budget well in advance. It is very important to have a budget which is approved from all your department heads rather than creating only by one particular founder sitting in silos. So take up approval, sit with your board members, sit with your team members to understand what is their plan and then prepare a budget. So in this video, we are going to go live with respect to an Excel sheet in a live case scenario and understand how can we create a budget for a particular company. So let's dive into it. Okay, so this is an actual sheet of a company with respect to their monthly P&L for last 12 months. When you're preparing the budget, it is important to take a help from your past previous financial data. This is your first year of the company, then you should have a certain benchmark in terms of where do you want to grow. So we are taking an actual detailed breakup of a company. So you can see revenue, cost of goods sold, gross margins, and the various costs which are directly divided into fixed cost and variable cost, and then there is a net profit. So the best way to go towards preparation of budget is map down on a monthly basis what is an actual performance the company has done. So what we have done, this is an actual performance for last 12 months. We prepared notes with respect to how do we want to project or what are the key criteria which is help us to understand with respect to projections. And then we've done a projected sheet with respect to the next 12 months. Either you can keep the projections in the same sheets, or if you want to move to a different sheet, you can create a separate sheet with respect to the projections of the company. So we are going to start with respect to preparation of budget. It is not very complicated as it is usually been told. So let's start with the revenue. The revenue is basically what the company is earning from their selling the product or services, right? So company needs to identify what is the unit price, how many units do they want to sell it up. So over here, if you look at it, the company is on an average selling around 12,500 to around 11,000 to 13,000 is something what the company has been selling, and the company right now targets to increase their sellings by around 25%. So I just write over here 25% increase from 12 months average. So that would be the growth, and month over month. So for 3 months, and for next 9 months, company targets to do 5% growth. So that's the assumption which a company has with respect to the growth of the company. So the average of the company is, we'll take an average. So 12,477 is an average, and we are going to increase by 25%. So I'm doing 1.25. So we are going to sell 15,597, then 1.25. And then company is going to grow by 1.05. It's the 5%. I'm just going to put this across with respect to all the period. Now the next thing is with respect to the per unit price. The company has prices which is from 400 rupees to 440. However, the company feels that they are going to fix the price at 440 only. So the pricing remains the same, which is the last month price of 440. So automatically we are going to get revenue, which is number of units sold into per unit price. Here is going to these two here. Oops, I'm sorry. So there's a mistake. So ensure that you're taking a correct formula with respect to the cell. I'm not going to discuss how do we going to use the formulas and everything. We can have a separate video with respect to that, but we are just going to understand the basics over here. Okay, now there is a 35% of raw material which has been used as in cost of goods sold, and they feel that the raw material cost is going to increase by again 5%, so it is going to be 40%. So it is going to multiply it by 40% with respect to raw material, which is raw material into revenue. Okay, packaging material is going to be the same, factory overheads are going to be the same. So revenue into 5% as a packaging material, revenue into 8%, which is going to be factory overheads. So these are the costs with respect to manufacturing of products. So this is basically any cost which is incurred with respect to manufacturing of a product is included in the cost of goods sold. It can be a direct cost as well as indirect cost. So direct cost is basically cost which is directly associated, and indirect cost is cost which is not directly associated. Now, so this is the gross margin of the company. Around 47% is what the company's gross margins are. Earlier, they used to have a gross margin of 51%. However, there has been decline due to increase in raw material prices, which is perfectly fine. Now, with respect to salaries and wages, so average they have got 50,000 salary to respect to per employee, and the current salary is coming to around 6 lakhs. So basically, 6 lakhs 20,000 divided by 50. So they have got close to employees 53,000. So they have got 12 employees. Now they are going to increase the employees by 2 employees in the month of first month. So we are going to get 14 employees into 50,000 per month. So 7 lakh is going to be my salary cost for the next 12 months, which I have accumulated over here. After 6 months, I usually give a bonus of 1 lakh rupee, and after again 6 months, we give a bonus of 1 lakh rupee. So I have just added this as an add of cost here to ensure that we have a complete employee cost being covered over here. Then we give employee benefits, which is again 20% of salary cost, which is this total salary cost into 20%. So this is the employee benefit. Now the training and development for which company incurs the cost, which is approx 5% of salary cost. However, the management feel that for this year they want to do more on training and development, and they are going to do 10% of the salary as a training cost. So this is going to be the total employee cost for the company. Next, moving to the sales and marketing expenses. So company is currently doing 3% of sales as an advertisement expenses, and company feels that they have developed the product really well and they want to reduce the marketing spend because they have acquired a good amount of customers already, and there is a recurring business which is going to happen. So they are going to reduce by to 2%. So this is our revenue, and 2% would be my sales and marketing expenses. This is my sales and marketing. Then with respect to promotions and discount, usually company do 85,000, anywhere between 70,000 to 85,000. And company feels that they want to increase the promotions and discount to 1 lakh rupees per month. So I'm just going to add 1 lakh as an ad hoc number and paste it over here. With respect to digital marketing, again on an ad hoc basis, they do it up something around 60,000 to 70,000. And company feels they want to do it, promote more on a social media and everything, and they are going to incur 85,000 per month. I have just added over here 85,000 per month. Now, this is the total marketing expenses with respect to what company is going to incur for the next 12 months. Now, next is the rent. So, company, if you see this past trend, the company has been paying 80,000 rupees per month as an office rent, and in this year there would be an escalation of 10%, 18,000 into 1.15, so which comes to 92,000, and for next year, next month onwards, it would be the same, right? Because rent cost usually doesn't increase much, like it's fixed, the cost, right? With respect to utilities, again, the company has identified the trend that the utility, electricity, water bills are usually 50% of the rent, so it is going to be the same. So we are just going to multiply by 50%, and this would be your next is again an office supplies, which is your stationery and all the related products, which the trend is 25% of rent. So we are just going to multiply by 25% of rent. Now, it is not necessary for all the expenses you will have the right set of correlations. At times, you will have to take an ad hoc number, or your budget owner should tell us that what is their target with respect to if they want to add up any more offices, or if you feel that your current employee cost, current number of employees would not fit into your existing office structure, and you would need to have one more offices, so you will have to increase your rent accordingly. That is something, it will depend on business to business case as well. Now, again, these are more of a fixed expenses, which is legal and professional fees. So company usually incurs anywhere between 50,000 to 55,000. However, company feels that, in this year, there are going to be additional legal expenses in this few particular months due to some existing legal disputes. So they are going to incur additional 1 lakh rupee in this particular month. Then it is going to be 60,000. And again, they want to make some additional budget for a year in the 10th month. So this is with respect to legal personal and professional fees now with respect to miscellaneous, which are usually your contingency or any other cost. The company last month have done around 35,000 as a cost, and in this month, in next year, they expect that to be gone up by 10,000. So I'm just going to budget 45,000 as in miscellaneous expenses. If you look at this is the total expenses which the company has been doing, which is total employee cost, marketing cost, admin cost, and this is the net profit before taxes. So gross margin minus your total expenses, which is net profit before taxes. And how do we arrive at a gross margin? Is revenue minus total cost of goods sold. Okay. Now, if we look at this total, so in this year, company targets to do around 15 crores of revenue. The total cost of goods sold would be around 8 crores, and your total expenses are going to be around 2 crores. So, company is going to achieve a net profit margins of 5 crores as compared to around 1.6 crores in the previous year. So this is the target of the company, and this is the budget which they have prepared with respect to the entire financial year. This will serve as a base for you in terms of the overall projections for the next 12 months. Now, what is really important when a particular month has been completed, that you need to add up a particular column which would be an actual. Okay, and you will have to put what is the actual performance, and then over here it would be variance, which would be either a positive variance or a negative variance. If it's a positive variance, it's a good thing that would be highlighted with respect to the management. If there is a negative variance with respect to cost has been increased or there has been overspent with respect to any particular budget head, that should be reported to the management along with the rationale for the same. So I hope you understood with respect to how a typically budget needs to be prepared with respect to the company long-term goals and objectives, right? I'll share this template as well with respect to a YouTube video, so you'll get an understanding how to. So with respect to how can you start preparing budget for the company. So there you go. You got a complete understanding in terms of how do you create a budget from a scratch for a company. Now, this is going to be a base for you as a finance guy or as a CFO of the company. As I mentioned at the beginning of the video as well, that it is equally important to take an approval from all your team members with respect to the budget owners before finalizing the budget. And the most important thing after preparation of the budget is to ensure that you're keeping a track on this budget, which is basically ensuring that you're measuring actual performance with respect to a budget. What I have seen is the company just prepare a budget for a year, then just completely forget about it. So that is not the way the budget would be helpful. It is important to understand what is an actual performance with respect to budgeted, and if there is any variation that needs to be done to your budget, that needs to be done. So basically a forecast needs to be created and a rolling forecast as well. Hope you like this video. Share it with your business friends, with your colleagues or your finance professionals if you found this useful. See you next time.